And why the Fed's rate cut won't save your credit card debt. What you need to know. Imagine this. You're juggling credit card payments. Each month feels heavier, and then you hear the news. The Federal Reserve just cut interest rates. A sigh of relief, right? Think again. Here's the truth they're not telling you. That rate cut you're banking on to ease your debt? It might not change a thing. But don't worry, I'll show you how to take control of your finances, regardless of what the Fed does. Stay tuned. Let's talk about credit card debt, something nearly every young American has struggled with. Fact number 1, credit card interest rates have skyrocketed, climbing from 16% in 2022 to over 21% today. Fact number 2, total U.S. credit card debt surpassed $1 trillion last year, a record high. Fact number 3, late payments? A staggering 8.8% of accounts are now delinquent. It's no wonder why. With interest rates like these, even small balances balloon into overwhelming debt. But here's the kicker. Even with the Federal Reserve cutting rates, most credit card APRs won't budge. Why? Quick question. Do you know the difference between your credit card's APR and the prime rate? It's crucial, and here's why. How Fed rate cuts work. The Federal Reserve sets something called the federal funds rate. This is what banks pay to borrow money from each other. When the Fed cuts this rate, borrowing costs generally go down. Great news for mortgages and car loans. But credit cards? They're a different beast. Why credit card rates stay high. Variable APRs. Credit cards often have variable interest rates tied to the prime rate, which is typically 3 points above the federal funds rate. APR margins. Over the years, the gap between credit card APRs and the prime rate has exploded. Even as federal rates drop, credit card issuers keep their APRs high to maximize profits. Case in point, during the pandemic in 2020, the Fed slashed rates to near zero. And credit card APRs? They dipped by just half a percentage point. So, if the Fed's decisions barely move the needle, what can you do to actually lower your interest rates and tackle debt head-on? Step 1. Check your APR. Start by finding out your current APR. You can locate it on your monthly statement or online account. Step 2. Request a lower APR. If your financial situation has improved, maybe your credit score is higher or your income has increased, call your issuer and ask for a lower rate. It's not guaranteed, but you might be surprised at what persistence can achieve. Step 3. Pay more than the minimum. Here's the golden rule. Never pay just the minimum. Even a small extra payment can save you hundreds, or even thousands, in interest over time. Step 4. Explore balance transfers. If your credit is strong, consider a balance transfer card with a 0% introductory APR. But be cautious. This strategy only works if you commit to paying off the balance during the promo period. Want to take your financial knowledge to the next level? One of the most powerful tools to grow wealth isn't avoiding debt. It's understanding compounding interest. Click on this video to discover how compounding can change your financial future forever. Remember, waiting for the Fed to fix your finances is like waiting for rain in a drought. It might help, but you'll thrive faster by taking action now. You have the power to control your financial destiny. If you found this helpful, don't forget to hit like, subscribe, and share this with someone who needs to hear it. Together, let's make wise money moves and build the life you deserve.